All right. So by way of recap, can anybody tell me what was the learning point yesterday?
If a transaction does happen and it's a collection transaction, if it's not stated explicitly, then first things first, you have to take it as cash. That's one. Two, we had a transaction that happened where we had a return of goods that we are not yet paid for, that we are bought on credit, right? And we were asked to treat that as, because we had treated the goods first, well, to knock off the payable back for the return of those goods back. Since it was bought on credit, we should go back and knock off from the payable. At least that's as much as I can remember, I understand.
Okay. Any other person that wants to try?
Okay, we were also taught. Good morning, everybody.
Good morning, Taiwo.
Okay, good morning. Yeah,
morning.
we were also taught. We were also taught about the 5 different types of accounts that we have. That we have the expense account, the assets, the liability, the owner's equity, and the revenue. And that revenue by nature is a credit. So if it increases, the account you plot it in on the credit side. The expense by nature is a debit account. We're also taught that assets by nature is a debit account. So anything that happens for assets, it's on the debit side. When it increases, we're taught that the liability is debit by nature, and owner's equity is a credit account by nature. We also thought of the various statement of accounts that we have, starting from the statement of financial position, income statement, statement of changes in equity, statement of cash flow, and then that's the +1 is the note to account. That's before we now, had that transaction example.
Okay, wonderful. Okay, so we'll just get started with what we have for today because time is not so much on our side. Let me see. Onyema, can I share my slide?
Yes, you can, please. Go ahead.
We met.
This morning, we'll be looking at adjustments and the construction of financial statements, which based on what we have this morning, and we'll try and quickly see how much we can cover because a lot is involved in this area. Getting to, by way of a background, we already have the established fact that accounting transactions are transactions that have to do with that has to do with increase or decrease in value for a business. And every transaction that has to do with accounting, or every accounting transactions, have to be recorded in your financial book or record or ledgers as the case may be. And I remember in one of our earlier classes, the prof mentioned that when we prepare accounts, it is based on principles, it is based on concepts, and it is based on established norms that have been put together over the years. And those are the basis upon which accounts are prepared. There are many bases. One of the very first concepts is entity concept, which I am sure many of us is aware of already. Another very important concept that we apply to what we are doing today, it's matching concept and periodicity concept, and I will explain. What does matching concept says? Matching concept says specifically that when you prepare accounts, the income you earn in a period, you match it against the expenses that was incurred in earning that income. When you do that, it becomes easy for you to see whether you have presented your account in a true and fair manner, so that the presentation of the account is a representation of the situation of the business. So the concept, which is matching concept, match your revenue and your expenses that happen within a period. The other concept is periodicity. Periodicity states that you prepare account to set period. Your account could be prepared, for instance, on a monthly basis. Your account could be prepared, say, for instance, on a quarterly basis. And your account could be prepared, say, for instance, on a yearly basis. It can be prepared to any other period, but these are the most common periods that is typically practicable on a monthly basis, on a quarterly basis, and on a yearly basis. So what this means is that when you prepare your account to any period, whether you have chosen monthly, quarterly, or yearly, as the case may be, you must be able to match the cost that you incurred for that period that you have chosen to the income you have earned for that period.
Someone need to mute his.
Please, can you mute your microphone so that we don't have interferences?
Go ahead. I've muted everybody. I'll mute everybody.
All right, thank you. So you prepared this account to this based on this concept, and when you choose a particular period, that becomes the basis at which you are comparing your revenue with your expenses. So we've talked about two concepts so quickly: matching, periodicity. And the third I want to quickly introduce is what we call the accrual basis. So when you prepare accounts, you can prepare your accounts based on cash basis, which means as the cash is coming in, you recognize it as income. As you are paying out, you recognize it, so it's on a cash basis. But we also do know that businesses are not run on cash basis alone. So because of that, when you prepare accounts on the cash basis, it does not truly reflect the situation of the business. There are certain entities that does prepare accounts on the cash basis. The most common one would be government. Government entities, they prepare their accounts on a cash basis. So on a year-to-year basis, it's based on what comes in and what goes out. So that is in the public sector. But in the private sector, we do not prepare accounts on a cash basis. Accounts are prepared on accrual basis. The accrual basis meaning that you take into consideration everything that has happened, whether you have earned, whether you have received the money, and when you have incurred an expenses, whether you have paid or not, it has to be recognized, provided all that activity happens within the period at which you are preparing the account. So because we prepare accounts on a periodic basis and we are using this accrual basis, there will be some adjustments that will need to happen almost every time that accounts are prepared. And that is why this issue of adjustments in accounts is very important. So when we prepare accounts, the process flow is that the first and foremost, you need to understand before you make any posting into your ledgers, what is the nature of this transaction? When you understand the nature of the transaction, it becomes easy for you to do the posting in the right way. So when the transaction happens, you want to ask yourself, what is this transaction all about? What is this transaction all about? That is the question you want to ask yourself. So when you run through that, you can be able to establish whether is this a sales transaction? Is this an expenses transaction? Or is it that capital has come in? Or is it that you have acquired an asset? Or whatever. Once you are able to understand and answer this basis, you now know, okay, this is a sales transaction, for instance. So if it's a sales transaction, you know, then you need to follow that, what that you learned yesterday, that for every revenue or sales, they are the same thing. So we'll be using them interchangeably. For every revenue or sales, it's a credit. And you ask yourself, where is this sales coming from? Who is your party that you are dealing with? That will be the other leg of the transaction. So for every transaction that you need to post, you must be able to critically analyze that transaction and ask yourself, what is the nature of this transaction? And provide the right answer. If at the point of providing that answer, if you provide a wrong answer, you are likely going to make a wrong posting, which will mean that your account will not represent the true and fair position that it should be. So it is important that you understand the transaction, analyze the transaction, and when you do have a fair understanding of what you are doing, you can now make this posting. Are we okay? If you can hear me, I'm trying to see the chat button here. Okay, so you do the analysis, understand the analysis, and on the basis of that, you make your posting. And like we've established, in your posting, there will be some level of adjustments. And these adjustments are coming because of the basis that which you are preparing the account that we have established. That once you prepare your account based on an accurate concept, you are going to have to make adjustments for revenue that you have earned, that you have not received money for, or for expenses that you have incurred that you have not paid for. So it is not unusual for businesses to have such transaction in such a way that there are many expenses that you have incurred and you are yet to pay. Take for instance, if you run a business and you say you are putting your salespeople on a commission, for instance, and you say for every 1 million, for instance, business that you introduce into the company, we are going to give you a commission of say 5%. And this commission will be payable on a quarterly basis, right? So what that means is that every month you need to establish who has brought what business and determine the commission that is due to that person. But mind you, you are not paying the sales team on a monthly basis. What that means is that you are going to recognize it and take note of it that, yes, somebody you are owing someone for commission, but you have not paid him. In such a situation, you are going to make that adjustment if you are preparing your account on a monthly basis and recognize that somebody is to be paid that 5% commission, but take note of it that the money will be paid 3 months from now. Or for instance, if you are into construction business, for instance, or you are into rent business and you have been paid for 1 year, which is not very unlikely. How do you recognize this money? Or for instance, you are a service provider like MTN, where we have to pay and buy credit before we use that, before we consume that credit. The moment we buy that credit for MTN, for instance, MTN cannot recognize it as sales, even though money has passed on to them. It only becomes sales for MTN or any other business in of their type when only you have used that credit. That is when MTN cannot say that they have actually made a sales. So these adjustments are very important that we need to make as we prepare our financial statement. And when you've made these adjustments, you've done all of this, we can now extract from our ledger. We have, for instance, your wages ledger, your sales ledger, your cost of goods ledger, your depreciation ledger, your telephone and expenses, utilities, all manners of ledgers. At the end of the period, we will extract all the balances of this ledger and put it on the credit side, those that are expenses and asset related, and on the debit side, those that are expenses and asset related, and on the credit side, those that are income and those are capital in nature. And we total the two sides. When they add up together, what we typically call that is what we refer to as the trial balance. So the trial balance is an extraction of all the balances that you have in your ledger. And the idea of preparing a trial balance is just to help you check whether your accounts are balanced. If you've extracted all the ledgers in your accounts and they do not agree in terms of the credit and the debit side, then it means that something has gone wrong in the process, which means the accounts, one of the accounts or two of the accounts are not correct. And you may need to go and look for those accounts that are not correct. Until your trial balances, then there is certainly a problem. So when you extract the trial balance, once you are done with that, you are able to post into the relevant account. Now, the balance sheets and the income and expenditure account. All revenue and expenses will go into your income and revenue account, and all assets and liabilities and owner's equity related accounts will go into your balance sheet. And that is the way your account will flow on the month-to-month basis, or the quarter-to-quarter basis, or on an annual basis, depending on the period that you have chosen that you want to report on. So that will be the basis, and we've already established the fact that when we prepare our account, we know that the revenue side, if there's an increase in your sales, you credit your revenue. If there is an increase in your asset, you debit the asset, and vice versa as the case may go. Same thing with your capital. If there is increase in your capital, what do you do? It means that it's going to come in by way of credit, because your owner's contribution or the member's contribution will increase, and of course your cash will be debited because you have received cash. And I'm sure by now we are all very familiar with all these debit and credit based on a series of transactions. So we just go to where we now have to make adjustments in an account. And where does this happen? where we say, based on the matching principle, we have situations where you have earned money or you have received money as a business and you are yet to deliver on that service, or you have incurred expenses, but that's expenses that you have incurred, the service is yet to be paid to you. In such situations, we have to make adjustments. And one of such adjustments is what we have as a prepaid expenses. So if the most popular one that many of us will be conversant with for this period is the prepaid rent. So you pay rent in advance, and because, let's say, the rent you have paid it for 12 months, and we are now preparing an account for every month, it means we will have to take 1/12 of that payment and recognize it on a monthly basis as an expenses, and we'll now have our prepaid expenses as an asset, because it's an asset that you have, but you have not consumed. So it is still standing for you as an asset in your book. And again, if you have also received money that you have not delivered the service, you have unearned revenue. All right, but that unearned revenue, what will be the impact? It means that your cash would have gone up because you have received it, but you have not really delivered that service. So you cannot account for it as sales because you have not delivered that service. And like the MTN example that I gave, so when we buy recharge cards, let's assume, for instance, I want to recharge my phone, and I buy a recharge card of, say, 5,000. As far as MTN is concerned, at this point, they'll have, and let's assume that is the only transaction in that day, they will have an unearned revenue of 5,000 because money has come into the account. They are going to credit that account on earned revenue, and they are going to debit their bank account, given that money has come in because they have actually received that money. So by the time I begin to make calls from that credit that I have purchased, after the day, they can now deduct how much is left and see how much they have actually earned, and make an adjustment between the unearned revenue account and the revenue account as the case may be. So these are the kind of adjustments that typically we make when we are trying to prepare our financial statement. So if you have any question, you can type it on the chat because we don't have so much time. We may not be able to wait till the end of the class to take that question. If we see it, my teams are here. They will respond to your question so that we'll have a clearer understanding as we progress in this discussion. So these adjustments are very important because if they are not made, your accounts would not be very correct and accurate in the accounts that we are trying to prepare. So we'll talk about the types of adjustments. We'll say cash received or paid before recognition. Before recognition of revenue or expenses. And of course, that will come as your prepaid expenses. We've talked about unearned revenues. Cash received or paid after recognition of revenue or expenses. Accrued expenses, accrued revenue. So you can have all of these as the adjustments that you typically will make in your financial statements for you to make the right entries. And all you just need to understand in making this entry is to ask yourself the question. So I have paid for a service or for whatever. The question is, have I enjoyed the benefit of that purchase. If I have not enjoyed the benefits, it means that it is prepaid. It means that your enjoyment of that benefit will come in the future. So you are going to recognize it as a prepayment. And at the time you are recognizing it in your book, it becomes an asset because you have not exhausted or consumed that benefit that you have paid for. Okay. So assume that the question here says, assume that Apple paid $200 to purchase time on MTV for future adverts. All right. So they have paid 200, let's say 200 million, okay, to purchase an advert time. So it means that the money will leave the account. All right. So you are going to credit the your cash account. Why would you credit your cash account? Because you are making payments, right?
Yes.
And you are going to debit. You are going to debit an account. All right. Which account are you going to debit? Ideally, if this payment you are purchasing, if you are going to exhaust the advert period for the month, for instance, you will just debit expense account because you have consumed that expense for that month. But because in this instance, the expenses you are paying for, it's going to lag over a period of time. So it probably might be for 3 months or for 6 months, as the case may be. And for that, because of that, you cannot just say that this month alone have consumed 200,000 or 200 million worth of adverts. If you do that, if you report your income statement for this month, it will not be a representation of what has actually happened this month. It means that you're actually subcharging this month for service that other months are going to enjoy. So to make it even and fair for all the months so that we can see our performance on month-on-month basis or on year-on-year basis, it would be nice for you to spread the expenses that you have incurred over the period for which those expenses actually relate to. So in this case, you are now going to make it a prepaid expenses and allocate to the various months the portion that belongs to those months. That is the kind of adjustment that we are talking about. So you recognize the fact that we have paid for an expenses, we have paid for an advert, okay? But this advert is for a period of time, say 6 months, right? Or 4 months, as the case may be. What you want to do is this month that has paid, it will only affect cash this month in total. But in terms of the expenses itself, we have to allocate it fairly among the period that we enjoy the benefit. And when you do that accurately, it will not support the fact that you are presenting your account in a true and fair way, in such a way that your account is fairly stated. So the adjustment will be your cash account will decrease by 200, and an asset called prepaid advert increases by the same amount. Once that happens, and subsequently, as you use the service, you begin to allocate the usage of that service to the period upon which that service is used. That is how prepayment is done. Same thing will also happen in an unearned revenue. And we're saying, assume that Apple receives 400 million cash from a customer as an advance payment on a multi-unit iPod say to be delivered next month. All right. You are going to make delivery next month. In this case, now you are selling a product, and the person, someone has paid you, you have not given him that product. you cannot recognize it in your book that you have made a sales. You can only recognize it in your book that you have actually received money, okay? Because your cash will go up because you have received money, but you also have to recognize the fact that you are owing someone because you have not delivered on that service that the person is paying for. And that liability side will increase by the equivalent amount. So these are the kind of adjustments that you do, and the time you now deliver the product, let's assume Apple now delivers the product a month later. So if it is still within the same period, all right? So in this case, they are talking about the fiscal quarter, which means that they are preparing this account on a quarterly basis. You will not take it away from your earned revenue account and take it to the revenue account. And in that case, your account will now fully be fairly stated. Same thing with accrued expenses. We've talked about, it's the same principle that happens in all of this as we try to prepare this, financial statements. And I'll just quickly go through and say if there are questions that we have asked, and if there's anyone that...
Hello, Austin. Hello, Austin.
Yes.
Your team,
yes, I can hear.
They're answering the questions, so I think you should carry on with the lectures. They're already answering the questions. Your CFA team, a very efficient CFA team. Yeah, so you can carry on with the lectures.
Thank you. So that is the way these adjustments are typically done, so that we prepare our accounts in the manner that is required. So we talked about the trial balance earlier, and just for emphasis, it's a listing of all accounts and their balances at a point in time. Why do you need to do that? So that it helps you to mathematically check the correctness of your account. And as a typical accountant, if your account is not in unison or if it's not balanced, your trial balance will not be correct. And that will tell you that some certain things is wrong. You need to go back and review it again to get it corrected. So this is a way a typical trial balance will look like, but for a regular company, you have many accounts and probably will run into many pages. As you can see on the debit side, we have all our assets and expense related issues. And on the credit side, we have our sales and liabilities and capital related issues. So look at on the debit side, for instance, you have cash on the debit. Account receivable is an asset on the debit. Inventory is an asset on the debit. Prepaid advertising, it's an asset on the debit. So on the debit side, you are going to have all your assets and all your expenses, all right? Wages, for instance, is not an expense, it's not an asset, but it's an expense, right? Advertising expense is not an asset, but it's an expense. Rent is not an asset, it's an expense. So your expenses and your assets on the debit side. So you need to take note of this and have it written down somewhere that expenses and assets, they always have a debit balance. And in your trial balance, they should be on that side of that equation. And on the credit side, let's look at what we have. Account payable, which is a liability. Wages payable, a liability. Rent payable, a liability. Common stock, which is your equity. Sales, which is your revenue. All of these are credit items. And typically when you sum them up, they should have the same balance. And when you have the same balance, it's a reflection that your account it's correct. Now, when you've established that your account is correct from this, you can now prepare your financial statement from these trial balances, because it's from the extract of all these balances you are able to prepare your financial statement. So in this case, you'll be taking your sales to your profit or loss account. You'll be taking your cost of goods sales to your profit and loss account, to your expenses item, to your profit and loss account. And at the end of the day, you are able to establish whether you have made a profit or you have made a loss. And all the liabilities and the assets, you take them to the balance sheet. And when you do it correctly, your balance sheet will also balance, which means that your total assets will be equal to your total liabilities. So from that trial balance, for instance, this is how our income statement will look like. If you look, we have sales. Quickly, if we go back, sales 1,600, right? So what does it do in your income statement? You have it as sales 1,600. Again, you go back. Typically, if you have your trial balance and you are posting from your trial balance, the best way for you to do this is you take your sales, for instance, you tick it for you to let you know that you have treated it, and you know that your sales, it's an account that should go to your profit and loss account. So in your trial balance, you should be able to understand at this point which account goes to where. We say majorly in your financial statement, we have 4 accounts, or 4 plus 1 as the case may be, right? Out of that, you have your balance sheet, you have your income statement, right? From the trial balance, you will know that all the things in your trial balance will end up in either in your profit or loss account or in your balance sheet. Everything in your trial balance, they will end up in your profit or loss account or in your balance sheet. So you need to know what will end up in your profit or loss account and what will end up in your balance sheet. How do you know what ends up in where? Revenue, which is sales, expenses, all revenue and all expenses related items will end up in your profit or loss account. Why? Because you are matching your revenue against your expenses and your cost of operation to determine whether you have made profit or loss. All right. So that is why they will end up in your profit or loss account. In your balance sheet, all assets and liabilities will end up in your balance sheet. Why? Because your balance sheet is a statement that shows your financial standing at a particular point in time. So you want to see what is your net worth, what do you have? So what you have is your total assets against your total liabilities. That will give you what is left for you. So from this, you should be able to identify what will go to where. And like I said, sales, revenue, anything that has to do with revenue, anything that has to do with expenses, will end up in your profit or loss account. Anything that has to do with your assets, anything that has to do with your liability will end up in the balance sheet. So you must be able to establish this point. And when you do that, it helps you when you do your posting. Otherwise, you are going to run into some issue. So just for emphasis, everything that has to do with revenue and expenses will end up in your profit or loss account. Everything that has to do with your assets and liabilities will end up in your balance sheet. And when we started, we say when you are doing your posting, you must ask yourself, what is the nature of this posting? What is the nature of this transaction? That transaction can be in either of these forms. It's either a revenue, it is either an asset, it's either a liability or an expenses. So when you understand what is the nature of that transaction, you will know exactly which parts of the accounting equation is going to fall into. So like here, for instance, our sales, we go to our profit and loss account. So we say this is our sales. What is the cost of the goods that we have sold? We are going to have it 1,150, and that is what we have here. Sales 1,600, cost of the goods that we have sold 1,150. When we find the difference between the sales value and the cost of the goods that we have sold, we will have what? Our gross profit, which means this is the profit that we make from selling this product. But again, we also know that when we run a business, with everything that has to do with business, is not just about the sales and the goods that we have sold. There are other auxiliary services and other things that support our sales process. And all these, you will have to less against your gross profit, like we'll see our wages, our advert, our rent. Okay, all of this you will see in the trial balance, your rent here, your advert, your wages, all of these are all expenses. We will less it from the gross profit, and what we have at the end of the day will be our net profit. It's just a simple equation. Just understand you have your sales, your cost of goods sold, we take it away from your sales. What you have left is your gross profit. From your gross profit, everything that is auxiliary to running the business, every support service that supports this operation, the cost of those support service, you bring it in and you less it against your gross profit for you to have your net profit at the end of the day. When you are done, you can also extract your retail earning. Retail earning at the beginning of the period is 0 because we are assuming that this is the first year of operation. We say net income. From this equation, we determine that we have a net income of 275. All right. So we have net income of 275. We have dividend 50. All right. And if you look at this, trial balance, for instance, dividend is not shown here, right? Why? Dividend is not really an expenses. So that is why dividend will not be shown in your trial balance. Dividend is an appropriation decision. Appropriation meaning like PDP and APC, how they share money. Yes, that is what dividend is. So when you have how you share the spoil of the battle, you have won the battle. What is left, we have to share it. And some of us that are in that business, we know how we share that money. Yeah. So dividend is not an expenses, it is an appropriation. So you will not see dividend in your trial balance, except it is a dividend that is yet to be paid. So it becomes a liability once you have declared it. All right. So you will not see dividend in your trial balance as an expenses, because dividend is not an expenses, but what? An appropriation. So we have said that we've made a profit of 275. We are taking a dividend of 50 away. And what we are left after we have shared that 50 among all the parties, we are left with 225. This 225, we are going to add it to the owner's equity, because it's the owners of the business that still have this 225, because don't forget, this 275 million or 1,000 million, whatever, belongs to the owner of the business because they earn all this money. But they've just shared 50 among themselves. This 225 is still left in the business, and that becomes part of your retained earnings. And if you go into your balance sheet. Yes, sir.
I have a question.
Okay, go ahead quickly.
Okay. The dividend is where my question is. Assuming, dividend is usually paid at the end of the financial year, but assuming they pay dividends within the year. Now, before you do your trial balance, let's say in your T accounts, like Femi mentioned yesterday. Now, he said asset by their nature, they are debit accounts, liability are credit accounts, owner's equity is a credit account, income is a credit account, and expense is a debit account. Now, what of dividends? If it is paid before the end of the year, will it be a credit account or a debit account?
Okay, thank you for your question. And like I said, dividend is not an expenses, dividend is not a revenue, dividend is not an asset or a liability. Dividend is what? An appropriation. And the word I use is sharing money. So dividend is let's share money. Okay? So it doesn't come in as a debit or credit. It comes in after the accounts have been prepared, and you now know this is what is left. So this is what is left. We have won the battle, right? The battle of running business. This is what we have left for running this business. We cannot share this money. So when we share this money, at that point, it is not an expenses that we are paying, because it is not an expenses, but it's just what? An appropriation. So it does not come in under any of those. Mind you, when you use the word dividend, it has to be in the context of the situation, because it is possible for you to see dividend as an income if you have invested in another company. All right. So if, for instance, MTN, which is a company, invest in Zenith Bank, all right? If Zenith Bank pays dividend, MTN will receive that dividend in their book as an income. That is different from the dividend that MTN will pay from their own operations. So there are two different things. The dividend that you pay from your own operation is not an income, neither is it an expenses, but an appropriation. So when you pay dividend in the course of the year, all right, what you just do is that you are taking money from the share of the profit that you have made in that year, or the share of the
how does it impact owner's equity at that point? How does it impact owner's equity? What impact does it have on retained earnings? That's the question.
Okay. So if you look at this here, for instance, if I don't know if you can see my cursor, yes, we have net, you have net income, 275. All right. So that is the money we have been able to make in running this business for this period. If we do not pay dividend, all these 275, we are going to add it to the owner's equity. Okay. All right. Okay. But if we pay dividend, it is what is left after we have paid dividend that impacts owner's equity. All right. Okay. Yes, that is the way it is when you are paying dividend from your operations. But in real life, sometimes dividend can affect your owner's equity in another way. For if you have to pay dividend from your prior year, it is possible for you to pay dividend from prior year. So all these retained earnings that you earned over the years, you can decide as, okay, this year, let me pay dividend out of them. In that situation, it will affect your owner's equity of the previous year, but that is usually not very common. It rarely does happen, but on the typical day, your dividend payment will not have your impact on the owner's equity because you take it off from your net income before you get to the owner's equity. So it is what is left that you transfer to the owner's equity.
Okay.
Are we good?
Sorry, one last thing. These slides, have you shared it in the?
Yeah, Femi shared the slides 2 days ago. I'm sure if we don't have it, we can still share it again. But I'm sure he shared it ago.
Okay.
Yes.
Let me check it. Okay, no problem. Thanks.
All right, thank you. So that is the way that account is prepared. And quickly, we'll go into statement of cash flow. Like you recall, I think Chair Mecca, before he left us, or before we rounded up with his class, he mentioned that cash flow statement is that is something that we should expect in his exam. So I think for us, it should be something that we should be very careful about and we should pay attention to. What is cash flow statement? We've said that cash flow statement is one of the accounts that we'll have in the financial statement. We say the financial statement, you have the income statement, you have the balance sheet, and you have the cash flow statement, the statement of equity, and the note. So cash flow statement is one of the accounts that you have in the financial statement. What does it do? It actually speaks to how we generate and use cash in our business. And this is one of the most useful accounts, particularly for an analyst who wants to have an understanding as to how a business is running. So when we prepare our account on an accrual basis, I can say that I have a sales. So I make a sales of 100 million, all right? A sales of 100 million in a particular year. Out of that sales, I have collected 40 million as cash and 60 million, it's on payable or receivable as the case may be, or receivable, right? If you run a business like this for many years, it becomes an issue because at some point you will be starved of cash because you are running business where you are not receiving cash as you are making your sales, and it will become a problem. For many of us, one of the reasons why insurance business have not grown in Nigeria or why they are not where they should be is because of this problem. Before about 5-6 years ago, when the regulators came up and say, come on, we can't continue to do business like this. And they came up with a policy of no premium, no cover, right? What used to happen is that insurance companies will book premium, all right? They'll book premium, but this premium are not paid. So it will stand in their book as a receivable. So they have assets that they are going to receive in the future. Now, when there is a claim, something has happened and there is a claim, they don't have money to pay this claim because they have not received the premium that they have booked, right? So it became a problem for them that they are not able to honor their obligation as at when due. And over the years, this led to people losing confidence in the abilities of insurance companies to actually do what they say. And that was a structural problem for that industry. So as businesses, it is important that your business, when you make sales, that sales is backed by cash. And when the sales is not backed by cash, it is going to give you problem because it means that your sales, that because you stand the chance of not being able to recover all the things that you have sold, the bad debt will come in, all of that. So because of all of this, we are always very interested to see whether a business is generating enough cash flow from its operations. We want to see where is this money that they are making money. And I'm sure some of us have heard the concept, and we've heard paper money, all right? I'm sure some of us have heard that, say, they are making paper profits. When you say somebody is making paper profits, it actually means that, yes, they have made profits, but that profit is not backed by cash. So when a business is making a paper profit, it is a problem. And for us as analysts or as investors, we do not want to invest in companies that are making paper profits. How do you establish whether a company is making paper profits or not? We are able to do that by gleaning through their cash flow statement. So the cash flow statement gives you the full head of an organization. Your income statement, you can manipulate. Your balance sheet, you can manipulate. But the cash flow statement is very difficult or almost impossible for you to manipulate it. So for those of us that are analysts and does work in this area, we pay a lot of attention to the cash flow statement because that is one of the statements that is almost impossible for you to manipulate, and it gives you a better idea of the health of the organization than what the profit or balance sheet figures may be telling you. So what do we do? Yesterday, I know we learned about the cash flow statement. I said that it is divided into 3 segments. We have the cash flow from operations, we have the cash flow from investments, and we have the cash flow from financing. These are the 3 areas where cash comes in and where cash goes out. So investment and financing, they are not a lot happens there. Financing, it's when new capital comes in or when you pay off your debts or the money you are owing. Investing is when you are buying new assets or when you are selling new assets. So typically transactions are not very many in this area. Where transactions are largely situated, it's on the operations, and that is actually where the business is. So a business that cannot make money from its operations in terms of positive cash flow is actually a problem, and it will not be too long before that business goes have serious issue. So what do we do and how do we calculate our cash flow statement? There are 2 ways, but we'll use the only one way that is recommended here in this test, which is the indirect method. We have the direct method and the indirect method, but we will stick with the indirect method. what do we do with the indirect method? So we go and we take the net income, all right? We take the net income from the profit that we have determined. From the profit and loss account, we get our net income, right? So we just take what we have in that profit and loss account as our net income. We have it here, so that is what you have here, net income, right? In preparing our profit and loss account, because the accounts are not prepared based on cash based, so we have to make adjustments for transactions that do not have anything to do with cash. One of such transactions that do not have anything to do with cash is depreciation and amortization. How do I mean? So let's say in 2018, we are running a company called UBA Capital, right? UBA Capital buys SUV for its chief IT officer, all right, of 40 million.
Okay, you define trouble. You define trouble.
What did you say?
I distracted our class.
So he buys 40 million worth of SUV, maybe a Prado, 40 million for their chief information officer in 2018. What will happen? The posting that typically will happen is that, the posting that typically will happen is that you credit your bank because money has left, 40 million, right? And you debit your asset, motor vehicle, 40 million. That is what we have been taught, right? When you do this, our accounts, it's okay for this period. But this 40 million worth of a car is based on company policy. It's supposed to use it for 4 years. So accounting-wise, we are going to say this 40 million, we divide it by 4 and charge a depreciation of 10 million every year. So in 2018, we will charge depreciation of 10 million. In 2019, we will charge a depreciation of 10 million. In 2020, you charge 10 million, and 2021, you charge 10 million, and of course, the life of that car is over. But bear in mind that in 2019, for instance, that was not when the car was purchased. But you are going to charge and debit your P&L with a 10 million charge, which means your P&L will be reduced by a 10 million value, which is a representation of the value of that asset for that year. For every other asset that you have in the company. So the depreciation figure that you have in the company, it's not cash based. The only time you have it as cash transaction is at the point of acquisition. And of course, when you acquire an asset, it will go into your your investing part of the equation. But in computing your profit and loss, you would have deducted the value of your depreciation from your cash, from your sales to determine what your net income is. So what do we do to make that adjustment? We will add back your depreciation. So this 10 million, for instance, let's assume in 2019, the profit that company made was 50 million net profit. All right. What we will do, we'll add back the depreciation figure that I would say it was 10 million. All right. So we'll add it back and we'll now have 60 million. Why? Because this 10 million that we are adding back, it is not cash based. It doesn't have, it's just an accounting treatment. All right. It's just an accounting entry. It is not that cash have left the business that year. The cash flow statement is interested in cash that is coming into the business and that is living in the business in that year. So we'll add back depreciation and amortization. Anything that doesn't have anything to do with cash transaction, we'll add it back. We'll also make adjustment for your current assets and current liabilities. All right. Current assets, we'll say they are assets in our balance sheet, right? So let's assume in 2019, In 2019, we have a total current asset of 200 million in our balance sheet. And in 2020, we will now have a current asset of 250 million. All right? If you check the difference, our current asset has gone up by 50 million. All right? Our current asset has gone up by 50 million. The question is, why will your current asset go up? Or what is the implication of your current asset going up? The implication of your current asset going up means that cash has gone down. All right? The implication of your current asset going up means that cash has gone down. So we'll take that in and say, okay, because our current asset has gone up, it implies that our cash has gone up, because it's only when cash goes down that our current asset can go up. Because if your inventory increases, it means that your current asset is going up. If your prepayment increases, it means that you have paid cash for your prepayment to go up. So everything that falls within your current assets, all right? Anything that falls within your current asset, if it goes up, the implication is that your cash has come down. So we have to take note of that. So we will take that effect and say, subtract the increase in current operating assets, all right? We also make adjustment for current operating liabilities. If your liabilities increases, it means that you were owing 100 million, for instance, in 1 year, and the next year you are now owing 150 million. The implication is that you have collected additional 50 million for what you are owing from 100 to become 150 million. Mind you, we are talking of operating liabilities here. We are not talking of that you have taken a loan, all right, and somebody will be thinking in his mind that, oh, if you have not paid interest, won't your loan that you collected at, say, 100 million go up by way of interest that you have not paid? No, that is not what we are talking about here. We are talking of operating liabilities. And operating liabilities, we are talking of creditors that you are owing, for instance. We are talking of those kind of short-term liabilities that you are using to run your business. So each time your operating liabilities goes up, the implication is that your cash has gone up. All right? So we take that value and add it back. All right? If it is that the operating liabilities has come down, it means that cash has gone down. And if that your operating assets has come down, it means that cash has increased. So I'll take it again so that
Austin, you have 3 minutes more.
Okay, I'll just round up in 3 minutes.
Me that have not understood this thing. Go ahead.
Okay, so what we are saying is that you take your net profit, all right? So we already know what our net profit is, all right? So that is simple. Add back your depreciation. Whatever depreciation you have for that year, just add it back. So if your net profit is 100 million from the account that you have, all right, and you can find from the account that depreciation is 10 million, just add 10 million to it. The implication is that your cash has increased by 10 million. For your operating assets, between the 2 years, okay, it's on the year-on-year basis or on the month-on-month basis, depending on the period you are preparing your financial statements to. Check for the difference. If there is increase in your operating asset, which is your current assets, if your current asset goes up, it means that your cash has gone down by that same value. And if it goes down, it means that your cash has gone up. So that is the effect. If your current asset goes up.
Austin, can you give a quick example of that current asset going up? So just use something to represent it, so that we understand.
Say inventory. Inventory is a current asset. It's a current asset. All right. And last year, our inventory is 50 million. This year, our inventory is 60 million. So if you can see that the inventory has gone up by 10 million, right? what we are saying that if your inventory has gone up between last year and this year, the implication is that your cash has gone down. So it becomes a negative. So you are going to less that 10 million from this equation that we are preparing. If on the other hand, for instance, your inventory was say 40 million last year, this year it is now 35 million. It means your inventory has gone down. How would your inventory go down? You have to sell for your inventory to go down, which means that cash has come in by 5 million. So that becomes a plus 5 million. All right? So that is the kind of adjustment that you need to make. So if your operating asset goes up, the implication is that your cash has come down. So it's a negative. So that is why we have this negative. And if your operating asset comes down, that means your cash has gone up. It is a plus, you have this. So when you do the summation,
the same amount, right?
Yeah, by the same amount. Okay. Exactly. So you are checking what your operating asset is last year against what it is this year. If it goes up, your cash has gone down. So you are going to have it as a negative. But if it has gone down, it means that your cash has gone up. You are going to have it as a positive. All right. So you're all going to have either of these. It's not the two of them. Either of. It's either is going up or coming down. And whatever the direction is, the implication for your cash is that if it is going up, it means that your cash is coming down. And if it is coming down, your cash is going up. The reverse is the case in liability. If your liability is going up, it means that more cash is coming in because you are taking more, you are collecting more money. That is why your liability is going up. And if your liability is coming down, it means that you have paid. That means you have paid some of your liabilities. That is why it has reduced. So the implication for your cash flow is that your liabilities will come down. So when you sum all of this up, all right, it will give you your cash flow from operating activities. If your cash flow from operating activity is positive, we'll say, yes, your business is doing well. But positive is not just positive, like it is just positive number. We want to see that the positive is healthy enough, which relates in relation to your kind of sales that you said that you have made. All right. So we compare that to see how much of this cash flow that you have from your operation, it's how close is it to the sales that you say that you have. Because really, if all the sales that you have made and all the expenses that you have made, if everything is in cash, then they will be very close. So we want to see all of these added together and you have a positive operating activity. If it is negative, it is a bad omen for the business. Nobody wants to invest in a business that cannot generate cash from its operations. It means that there is crisis or something is wrong in that business that we need to look into. So for an investor, you don't want to invest in that kind of a business. For an internal person, you want to see that, look, there's a problem. We need to change the things, what is not working to ensure that our cash, our net operating cash from our operations is positive. And that is very important for the business. So I think our time is off. If there is any other question, I'm sure we'll still have another session maybe by the end of the day to take additional questions from if we have areas of clarification. But this is very important. We need to play with it and get more understanding with it, given that the lecturers have indicated that it's a very strong area for him, and it's almost certain that we will have something like this coming out in the business in the exams. So I don't know if it's 10:18 right now by my time, so eating deep into the other session. Thank you. I think we'll take more questions at the end of the sessions, and we'll try and get additional clarification.
Thank you, Austin.
Thank you very much, Austin.
Thank you.
Thank you. Thank you, Austin.
Thank you, Austin.
All right, thank you.
I understand, thank you, but I still don't fully understand this cash flow stuff. I understand it, but I wish we could run an actual transaction and see what it feels like.
Okay, Oyema, we will do it again. We'll definitely have to do it again since it's an exam question. So, but not today, but maybe next one. Because we have another class already set for this time.